Hey everyone, and welcome. So glad you could join me. Today, we're going to crack open one of the most important and, let's be honest, one of the most misunderstood sectors in the entire market, banking. So here's the big question, right? How can you tell a safe, profitable bank from one that's, well, about to blow up? Banks can feel like a total black box. I mean, they deal in money, their balance sheets are just massive and super complex. So how do we as investors peek inside that box? How do we find the good ones and avoid the ticking time bombs? That is exactly what we're going to figure out today. Welcome to another Explainer on Investment Basics. I'm Majid Butt, and my goal here is simple. We're going to demystify bank stock analysis. I want to give you a clear, practical blueprint so you can really understand what makes a bank tick, what drives its success, and how you can spot a quality investment from a mile away.
And hey, you're going to want to stick around till the very end. Why? Because I've put together a summary checklist that boils everything we talk about today into a simple, actionable tool. It's the perfect takeaway, I promise.
Okay, so here's our game plan for today. First, we're going to strip away all the jargon and look at the surprisingly simple business model of a bank. Then, we'll dive into the real heart of it all, the 3 core risks every single bank faces. After that, I'm going to give you an investor's toolkit, the key numbers you need to know. And finally, we'll wrap it all up with that checklist. All right, let's jump into section 1, the business model. You see these banks with trillion-dollar balance sheets, and you think, it must be impossibly complex. But the truth is, what they actually do is, well, it's simpler than you think. At its core, it really just boils down to 3 simple steps. Step 1, they take in our money, right? Our checking accounts, our savings accounts, these are called deposits, and that's the raw material for the bank. Step 2, they take all that money they've gathered and lend it out to other folks, people buying homes, businesses expanding, but they charge a higher interest rate. And that brings us to step 3. They profit from that difference, that gap between what they pay us and what they charge borrowers. We call that the spread. And this spread has an official name you've got to know: net interest income. This is the absolute core engine of a bank's profitability. Think about it. If a bank pays you, say, 4% on your savings and then lends that money out at 6%, that 2% difference? That's its net interest income. Simple as that. Now, sure, they make money on fees and stuff. That's called non-interest income. But this spread, this is the main event. Okay, so if it was that simple, just making money on the spread, every bank would be an amazing investment, right? But it's not that easy, not by a long shot. Because the real business of banking, the heart and soul of it, is all about one thing: managing risk. And that's what we're diving into next in section 2. So at the end of the day, banks get paid to take on and manage 3 huge fundamental risks. First, you've got credit risk. This is the big one. Will the people they lent money to actually pay it back? Second is liquidity risk. This is the classic bank run you see in the movies. What happens if too many people want their cash back all at once? Can the bank handle it? That's why their capital, their equity, is so crucial. It's the shock absorber. And third, there's interest rate risk. This one's a bit sneakier. Imagine a bank is full of 30-year mortgages at a low 3% rate. But what if new interest rates shoot up to 7%? Suddenly, that bank is stuck earning a tiny return while having to pay way more to its depositors. That spread we just talked about, it gets totally crushed. So a great bank is really just a great risk manager across these 3 areas, period. And this quote from J. Paul Getty just nails the idea of credit risk, doesn't it? If you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. Every loan a bank makes is a bet. One small borrower defaulting, no big deal. But if a huge borrower goes under, or thousands of small ones all at once, well, suddenly it's the bank's problem. A very, very big problem. And this is how they protect themselves. This is their biggest shield against that credit risk. If you or I lend all our money to one friend and they don't pay us back, we're out of luck, we lose 100%. But a bank? They can build this massive diversified portfolio with thousands of loans. It's the ultimate don't put all your eggs in one basket strategy. A few defaults here and there, it's just a cost of doing business. It won't sink the ship. Okay, so how do we as investors spot a bank that's getting sloppy with its lending? You need to look for these red flags. First, keep an eye on charge-offs, that's a loan the bank has totally given up on, and delinquencies, which are just late payments. If you see those numbers suddenly spike, that is a huge warning sign. Second, listen to management. If they're on an earnings call and they can't give you a straight answer for why their loans are going bad, run for the hills. And finally, be really suspicious of a bank that's growing way, way faster than everyone else. It's easy to grow fast if you just lower your standards, but trust me, those bad loans always come back to bite you.
All right, we've got the business model down. We understand the core risks. Now it's time to get our hands dirty. Let's get practical. Section 3 is all about your investor's toolkit. These are the key numbers you can pull right from a bank's financial reports to see for yourself how healthy it is.
First step in our toolkit is return on assets, or ROA. This is probably my favorite metric for banks. It's so clean, it cuts right through the noise and answers one simple question. For every single dollar of assets on the books, that's their loans, their cash, all of it, how much profit is the bank actually squeezing out? It's a pure measure of efficiency. So what's a good number to look for? The benchmark for a really well-managed top-tier bank is an ROA consistently in the 1.2% to 1.4% range. Now I know, that number sounds tiny, right? But you have to remember, we're talking about billions or even trillions of dollars in assets. So that seemingly small percentage translates into massive profits. It's the hallmark of a great operation.
Okay, next up is a metric you've probably heard of for any company, return on equity, or ROE. This one is all about us, the shareholders. It asks, how much profit is the bank generating with the money that people like you and me have invested? It's a direct look at how well they're working for their owners.
So what are we looking for here? A really solid bank should be churning out an ROE somewhere in the mid to high teens, consistently. And this is a huge but. You have to be super careful with this number. If you see an ROE that's crazy high, like over 30%, that should be a red flag. It's actually pretty easy for a bank to juice its ROE by taking on way too much debt or by not saving enough for a rainy day. Both are incredibly risky moves. All right, our third tool is the efficiency ratio. I love this one because it's a great gut check on how disciplined management is. Basically, it measures all their overhead costs, salaries, rent, technology, as a percentage of their revenue. To put it another way, it tells you exactly how many cents a bank has to spend just to make $1. And with this ratio, the rule is dead simple. Lower is always better. If a bank has a high efficiency ratio, it just means they're bloated. They're spending too much to keep the lights on. The really lean, mean, disciplined banks, they consistently run with an efficiency ratio below 55%. That's how you know they're running a tight ship. Last but not least, let's talk about valuation. How do we know if we're paying a fair price? For most industries, the price-to-book ratio is kind of useless. But for banks, it's an absolutely fantastic tool. And the reason is simple. A bank's assets are mostly money. Loans, cash, securities. So its book value is actually a pretty solid estimate of what the bank is truly worth. So here's a great rule of thumb for you. If you find a really high-quality bank, one that's ticking all the boxes we've just talked about, and it's trading for less than 2 times its book value, that's a signal. That's a bank that's worth a much, much closer look. Now, of course, you still have to do your homework and figure out why it's cheap, but it's an awesome starting point for hunting for value. Okay, we have covered a ton of ground, haven't we? We started with a simple business model, we dug into the 3 core risks, and we've built our investor's toolkit. Now it's time for the final section. Let's put it all together with that actionable checklist I promised you at the start. Okay, here it is. This is your blueprint. When you're looking at a bank, just ask yourself these questions. 1. Is the whole business built around smartly managing credit, liquidity, and interest rate risk? Is that their focus? 2. Is it run conservatively? Look for that strong equity base, an equity-to-assets ratio of around 8 to 9%. That's their safety cushion. 3. Can it grow its income steadily, even when the economy gets rough? You want a bank that's durable. 4. Is it consistently profitable? We're talking that ROA over 1.2% and an ROE in those healthy mid-teens. 5. Is it efficient? Is that efficiency ratio under 55%? And finally, number 6, after all that, is the price right? Is that price-to-book ratio reasonable for a solid bank, maybe under 2? If you can answer yes to these, you're on the right track. At the end of the day, your 2 best tools for investing in banks are patience and a healthy dose of skepticism. The market will always serve up opportunities. The key is being prepared to see them clearly when they arrive. So I'll leave you with this question. You have the blueprint now. Are you ready to cut through the noise, look past the headlines, and find the real value?